Warren Buffett is known as one of the greatest investors of all time. Many people seek to know his secrets and duplicate his success. It would be great to learn to invest as Warren Buffett to hit that billionaire status, but not all of us have the time, money, or resources to achieve the same success. It may be more straightforward and easier to rely on an exchange-traded fund or ETF. Those usually have a mix of different companies that help make the fund, and it can be easily bought off the stock market and traded if need be. Which ETF would Warren Buffett suggest hitting $1 million? Warren Buffett's favorite ETF. It is hard to say which is his favorite ETF. Warren Buffett owns two ETFs. One is Vanguard's S&P 500 ETF, VU. The other is SPDR S&P 500 ETF Trust, SPY. SPY and VU track the S&P 500, a collection of the top 500 companies in the U.S. These S&P 500 ETFs track the S&P 500 index, which allows investors to have an investment that matches the market. For an investor, these two ETFs can make a good core of your portfolio or be the only investment in your portfolio. Warren Buffett believed in these two ETFs so much that in 2008, he bet 5 different hedge funds that the S&P 500 ETF VU would have a better return in the 10 years. He was right. The ETF had a 126% return over those 10 years, while the hedge funds averaged just 36% in that same period. When the best investor in the world makes a bet, it is hard to bet against him, and you can see that your money will be safer and earn a higher return just by investing in VU or SPY. What makes these investments so good? You may wonder why invest in this ETF over another. There are many reasons, such as the S&P 500 having the top 500 companies in the US market. It has Apple, Microsoft, Tesla, Google, and Amazon. Then you have value companies like Johnson & Johnson and Home Depot. Another reason could be the simplicity. All you have to do is buy the fund, continue to buy and hold it throughout the years, and let the market work. The fund will cleanse itself, and minimal work must be done. It is simple. Lastly, these index fund-style ETFs have low costs. VU has a 0.03% expense ratio, and SPY has a 0.09% expense ratio. So, it costs you $3 to $9 per $10,000 invested in matching the market. A hedge fund manager or other fund managers may cost much like up to 1–2% of the portfolio, and you will still lose to these two ETFs. How does this ETF hit $1 million? Compounding interest is a powerful thing. As the interest continues to build, the much you invest continues to grow. The S&P 500 has had an average return of 10.7% over the last 30 years, and if we stretch that to 50 years, it is an average return of 11.25%. If you had $3,736 invested with an S&P 500 ETF and never invested another dollar, it would take 59 years to hit $1 million with a rate of 10% if you invest $300 a month, $10 a day. Then you would hit $1 million in 34 years. With $10,000 a year invested, that money would hit $1 million in 24 years. Investing just a little bit every month can help your money grow. Warren Buffett knows this best. As you work on creating a more extensive portfolio, keep the investment simple, and try to invest as much as you can. The earlier you start, the better to get that compounding interest to work for you. Should you invest in the S&P 500? If you want to avoid researching or hiring someone, keep it simple. Invest in an ETF that tracks the S&P 500. You can even go for an excellent total market ETF. If Warren Buffett says to invest in it, then it is a good idea to trust him. He didn't become the greatest investor of all time based on luck. SPY versus VU. Which S&P 500 ETF is the better buy? Where is a good place to put my money? I hear people saying. What is a good investment strategy? Usually, I would suggest a good index fund or index fund ETF. Where to start, and which one to choose? Look no further than SPY versus VU if you want to get started. These are two of the best ETFs to choose from. The good thing is that you cannot wrong with choosing either. What is an ETF? An ETF is an exchange-traded fund. It works like a mutual fund but is traded on the open market like a stock. Many companies have been creating ETFs to create another type of mutual fund that they can sell to clients. They are a great way to make an investment portfolio done passively. When talking about ETFs, there are usually two types that people refer to. Those are the ETFs that are actively managed, and then there are the ETFs that are index funds. Most people talk about the ETFs that have been created out of an index fund like VTI as the ETF of BT Sachs. The actively managed ETFs usually try to outperform the indexes, but in the long run, it is rare. There are other ETFs that are actively managed. Those tend to have higher expense ratios that can cost you more money in the long run. SPY versus VU are two of the best ETFs you can go with to put in your investment portfolio. Why SPY versus VU? Why these two ETFs, exchange-traded funds? These two ETFs track the S&P 500 index. They are comprised of the 500 largest companies in the USA. These two ETFs have some of the most oversized market caps around, and they give you the ability to create an effective investing strategy. If you want to look at some numbers to see how these bad boys are doing, look no further than 2021. In 2021, the S&P 500 has returned an impressive 28.7%. On average, we see the stock market getting about 10%, and 2021 was just a great year. 85% of mutual fund managers failed to beat the S&P 500 in 2021. So, it is a safe bet to go with an index fund like SPY versus VU. Since these two ETFs track the same thing, they should be interchangeable or similar. These may follow the same index, but slight differences may help you sway one way or another. SPY. SPDR S&P 500 Trust Overview. Looking at SPY, it is one of the oldest ETFs out there. This is the ETF most people will think about when they hear the word ETF. SPY was created by State Street in 1993. Therefore, it holds as one of the most known and most liquid ETFs on the market. It is easy to trade this ETF, and it comes with a 0.09% expense ratio to help manage the fund. Past performances never mean that future performances will be the same, but it is a good indication of how this fund has performed over the past 10 years. The index fund does a great job of exposure to the US's large cap companies. Here are the top 5 sectors of the fund. 1. Technology, 31.82%. 2. Financials, 15.10%. 3. Consumer discretionary, 13.54%. 4. Healthcare, 11.27%. 5. Industrials, 10.83%. The top 10 companies that occupy 31.40% of SPY. 1. Apple. 2. Microsoft. 3. Amazon. 4. Alphabet. 5. Tesla. 6. Nvidia. 7. Meta Platforms. 8. JP Morgan Chase. 9. Berkshire Hathaway. 10. Home Depot. On a 10-year average, the rate of return has been about 16.40%, which is pretty good looking at the stock market average of around 10% annually. So has done well for the past 10 years. As the market continues to grow on this massive bull run, this ETF grows even more. This is a popular fund that financial advisors may suggest as well. My father's ex-financial advisor told me about this ETF as I asked more about index funds. Looking at a good place to start investing, SPY offers a history of great returns. It provides low cost at the cost of 0.09%, and you cannot go wrong with the best 500 companies on the US stock market. Vanguard created VU as an ETF to VFIAX. Its inception was in 2010 and has averaged about 16.51% per year for the last 10 years. The expense ratio is 0.03%, making it one of the cheapest ETFs on the market, bringing savings to your pockets. These are incredible numbers. As you can see, VU is an excellent ETF that matches the S&P 500 at a low cost, and it can bring stability through a company like Vanguard. Warren Buffett is a great fan of this fund because it allows you to have exposure to the best of the best when talking about companies in the US. The index fund does a great job of having exposure to the entire market. Here are the top 5 sectors of the fund. 1. Technology, 31.82%. 2. Financials, 15.10%. 3. Consumer discretionary, 13.54%. 4. Healthcare, 11.27%. 5. Industrials, 10.83%. The top 10 companies that occupy 31.40% of VU. 1. Apple. 2. Microsoft. 3. Amazon. 4. Alphabet. 5. Tesla. 6. Nvidia. 7. Meta Platforms. 8. JP Morgan Chase. 9. Berkshire Hathaway. 10. Home Depot. After looking at some of these numbers, you already see a slight difference between SPY versus VU. They are both tracking the same index, but VU is outshining SPY on a 10-year average of 0.09% due to the lower expense ratio. SPY versus VU. The similarities between the two. Track the S&P 500. Both track the S&P 500 index. They are comprised of the top 500 largest companies in the USA. Having this many companies allows them to have significant exposure to large cap companies. Since the S&P 500 did so well this past year, the return on investment has reflected that. These two ETFs will also go up in value if the market goes up. Similar top 10 companies. The top 10 companies in the index make up about 31% of the fund. These companies include Apple, Google, Amazon, Facebook, and other companies like JP Morgan Chase. These two funds have a large percentage into tech, with other companies rounding out the bottom 10 consisting of banks and daily goods. Diversification is key. These two ETFs are pretty diversified. They are into 500 different companies, and there is not a massive investment into one company over another. There is no 10% allocation into one single company or another. Yes, 31% is invested with the top 10, but many other companies help raise the ETF. Only invest in companies in S&P 500. They only invest in companies once they hit the S&P 500. This can be a negative since you have companies like Tesla that entered the S&P 500 on December 21, 2020, and the S&P 500 could not capitalize on the stock growth that had occurred in most of 2020. There are also no small cap companies that are in the ETF as well. These are all large cap funds. These index funds are pretty similar. There are many similarities between these two index funds. If you are ever looking for a more rounded ETF or index fund, you can look at VTI or VTSAX. They track the total stock market, giving more exposure to over 4,000 different companies instead of the 500 in the S&P 500. The difference is between SPY versus VU. Here are a couple of differences between SPY versus VU. The expense ratios. The expense ratios are a big difference. SPY has an expense ratio of 0.09%, while VU has an expense ratio of 0.03%. That is a difference of 0.06%. The higher the expense ratio, the lower the return for the investor and the more money for the management company. Costs may not matter much to you, but having a lower expense ratio can help improve a return. As you can see, VU has a 0.09% better return than SPY over a 10-year average. It is minimum, but if you have $1 million invested, that is a difference of an extra $900 every year. Management companies. Investment management is a bit different. The customers own Vanguard. It does not seek to make money for any shareholders. This is an important thing when you think about it. They are in the business to make the customers money and not the shareholders. The shareholders own State Street. Its objective is to make sure they make money for their shareholders. When I see this, I have to wonder if they have my best interest or the shareholders that have the best interest at heart. Liquidity. Liquidity is another thing. You can make better options in trades, and trade volume allows people to trade options much more accessible with SPY rather than VU. SPY is one of the most traded ETFs out there. SPY is probably a better ETF to hold with a larger market cap if you are into ETF trading. If you are looking to trade call options, then it would be best to go with SPY. With the high volume of trades occurring, SPY will be a great asset to sell call options. The yield. There is also a slight difference in yield. SPY has a yield of 1.30%, and VU has 1.34%. They distribute their yields differently, with SPY having a much larger payout at the end of the year than VU. VU's dividend is usually spread out more equally throughout the year. SPY versus VU. Which one should you choose? The question of which ETF to choose is a hard one. My personal opinion would choose VU. They are essentially the same. I would choose VU because of several reasons. First, it has a lower expense ratio. SPY and VU are both low-cost ETFs that can bring you excellent value, but costs can impact your investment over the long haul. Secondly, Vanguard is owned by the customers. They must make sure the investors are taken care of. By lowering costs, it helps the investors. The shareholders own State Street. That means they could raise the expense ratios to make more money for their shareholders. With that aspect looming over, I will choose VU. I know that Vanguard is a company for its investors. It is up to you which one you would choose. Investing is never an easy task. There can be a lot of psychological barriers that may interrupt things like a bear market or even costs. The fear of missing out or even losing money can create different thoughts when coming to investing. If you want to start, then choose one of these ETFs. SPY and VU can do wonders for your portfolio. All you need is conviction in the US economy. Look around you. If you see people on iPhones buying things on Amazon through Google, then chances are the American economy is doing pretty well. Make a choice and choose which one is right for you. You cannot go wrong with choosing either. This is the start of a new adventure into investing. Thank you so much for watching this video. We appreciate your continued support and look forward to serving you with more exciting videos in the future. We hope it has been helpful in understanding the world of passive income. Don't forget to hit that subscribe button, like and comment below and turn on your notifications so you never miss a video from Passive Income Journey 777.